risk assets such as stocks, corporate bonds and bank loans have been trading in a wide and volatile range. Pronounced fluctuations within the trading range reflect primarily the tug-of-war between a weakening global economy and continuing liquidity injections from central banks and corporate balance sheets. The fluctuations are accentuated by patchy market liquidity. On the way up, prices overshoot levels warranted by the exceptional funding that markets obtain. This behavior is likely to continue in the short term, shifting the opportunities for higher monthly, quarterly returns away from conventional strategic long-term portfolio positioning and toward more short-term trading and volatility trades. Today's markets are heavily influenced by the direct and indirect involvement of central banks. Correlations among asset classes are less reliable, weakening the effectiveness of risk mitigation through traditional portfolio diversification. Over time, the trading range is more likely to get wider than smaller. As this occurs, the probability of either a policy mistake or a market accident will increase. And even absent these two disruptive developments, the range itself will become increasingly fragile as it gets wider. A constructive policy response would require a transition from the excessive reliance on central banks to a set of policies that reinvigorates growth engines, deals with aggregate demand imbalances, addresses excessive pockets of indebtedness, and makes progress in completing regional and global economic, financial architectures. The more this policy handoff is delayed, and the greater the political polarization, the higher the probability of notably lower markets that, in turn, would risk contaminating economic fundamentals and making the politics even messier.